3, 2, 1.
Blast off.
Magic time.
All right.
All right.
It is almost the end of March. It's getting cold again this week.
I don't want to even talk about the weather. I'm getting so mad. It gets warm, and then I had my flip-flops ready.
No,
you know,
not next week.
Jerry and I went to Key West a few weeks ago just for a quick little, weekend trip. Wasn't anything, spectacular, but it was nice.
It was nice.
And I was like, all right. We get back home. It's going to be in the 60s, and it was for a few days. And pop. No. You're getting old when you talk about the weather. So.
Yeah. Let's talk about something else. I feel like I'm getting old with the stuff we're going to be talking about here, too, but that's okay.
What you got for us this week?
Right. So, popular demand. People are asking about support and resistance, what it is, why does it work, what does it matter? It's not an exact science, but we're going to go through some of the Investopedia definitions and examples and things of how it works and why it works.
Now, see, Jerry never tells me, or I don't know what's coming up on the show, right? I just put it all together and he goes. And that gives me a great opportunity to kind of go off the cuff. But before we started the show, he's like, I think people's eyes are going to glaze over on this one today. And I'm like, usually when you say that, like, it's really good stuff. And sure enough, here we are, and something that I would say is probably one of the key components of what we do.
It is
support and resistance.
Yep.
And if there's people that don't understand support and resistance, it's not what we do. It's just the basis of technical analysis, right? People should need to understand these.
They are important concepts.
Very
no doubt
important. So don't glaze over, folks. If you're listening to this, stop what you're doing, grab a pencil and paper, and
we get the links in there, and you can go to it on Investopedia later. But really, the thing that I was kind of talking about people's eyes rolling over was more the yield curve. It's
that one's a rough one.
Yeah,
I remember when we were taking our exams. It took me a while to wrap my head around that.
Yeah. We're gonna go.
It's not intuitive.
No. But we're gonna just kind of go over the basics. And actually, if you are a subscriber to the site, I do a pretty big section of the newsletter this weekend is about the yield curve. So you definitely want to read that. And then the only chart that matters, things have definitely changed this week. If you don't know about that, we will talk about it. And then the regular TSP fund charts. Okay. So we'll do the concepts and then how they apply to both trend lines and moving average lines. So support is the price level when prices are moving down, right? Prices move down, and the place that you can expect it to pause is where there's a concentration of demand for buying, right? People want to buy at a certain price level, and that level, it's not an exact number, it's like a zone. And once it gets in there, a lot of buying interest comes along, right? So as the price of the assets or security drops, demand for shares increases at a lower price. And this is what forms the support line. Okay, so meanwhile, on the other hand, is the resistance zone, right? So the resistance zone comes due to selling interest when prices have increased. So when price goes higher and starts bumping up against resistance levels, it's the place where there's less buying interest and more selling interest, which this doesn't really apply to TSP, but in this case, when they say selling interest, it literally means people short selling at those resistance levels.
Mm. I think of support as ceilings and resistance as floors.
Yeah, exactly.
Yeah. And I think what's important for people to realize, and it took me a long time because I'm a slow guy, I'm an old knuckle dragger, but it took me a long time to just realize and accept that the stock market is people.
Yep.
Right? We think of it as companies and things, and it is people. People run companies. Yep. Institutions are run by people. So when we talk about buying demand and this is real. So when we talk about price action a lot, right? When we say price action, I think people action.
Yeah.
Because it's people taking an action based on an assumed thing, right? That level of support, and that means there's a lot of people that think that's what the price should be.
Right. It's whatever the value you think. So if you're going to go out and buy a car, and right now, because I'm actually looking at it right now, right? The average price of a new car just ticked over $47,000.
Yeah.
The average price of a used car is just over $30,000. Both of them are at all-time highs, right?
Exactly.
So in my mind,
that's all perception of people's value of the the thing, right?
Right. That's what the average price is, right? But in my mind, I'm like, I'm not paying $30,000 for a used car, right? Now, is it worth $25,000 to me? Yeah. So as price comes down, I might buy it at 25.
Right.
And there might be other people that would buy it at 25, and that's going to be a support level for price going forward. And maybe it's 30,000. Maybe I'm behind the power curve, and I'm not, I'm going to have to overpay what I personally think I should have to. Right. I mean, that's just how it all works the same.
Yeah, it's exactly the same.
And if there wasn't a human component, like you're saying, then there wouldn't be support and resistance levels.
Yeah.
It would literally be whatever the value, however how much the parts are to make the car, that would be the price of the car.
Yeah.
But that doesn't work that way.
Yeah, because these cars don't cost $30,000 to make.
Right.
But yeah, it's demand and supply, and it's people.
People. Yeah.
Absolutely.
So okay, once an area or zone, right? And this is a big thing because people always are commenting about what's so special about that one line, 4,300 in the S&P. It's more of a zone. It's a better way to look at it because there's not going to be there's no magic number. It's an area. So once that area or zone of support or resistance is identified, the price levels can serve as a potential entry or exit point because as price reaches that support or resistance level, one or two things is going to happen. And we talk about it all the time. It either bounces away from that support or resistance level or it violates it, right? And it continues in the direction that it was going. For us, in terms of TSP, we want to have it confirm because we only have the 2 IFT moves a month. So in a non-TSP account where you don't have to worry about that, when price comes down to a support level, you might buy it, knowing that if it drops through that support level, you just get out. You just sell it for a small loss, but the potential upside is huge. And I think that's what So in the last paragraph, the timing of some trades is based on the belief that support and resistance zones will not be broken. Whether price is halted by the support or resistance level or it breaks through, traders can bet on the direction and quickly determine if they are correct. So if you're at a support or resistance level, that's your best time. That's the best risk-reward place that you can make a trade. That's for sure. But then we have to apply our IFT rules. That's the hard thing about TSP. So if price moves in the wrong direction, no problem. The position can be quickly closed for a small loss. If the price moves in the right direction, the direction you expected, the move can be substantial. You can make a ton of money there. Okay, so for an example, Jim notices that price falls. Let me just flip forward here. This chart on the left is the one we're talking about in this example. Okay, you got a ceiling, a whole bunch of resistance here at 39. Okay, so Jim notices that price fails to get above 39 several times over the past couple months, even though it's gotten very close to moving above this level. In this case, traders would call the price level near 39 resistance, right? As you can see from the chart, resistance levels are also regarded as a ceiling because these price levels represent areas where the rally runs out of gas. So it comes up to 39, rolls over, makes new lows, make another rally attempt, hit 39, rolls over, big gap down, fills the gap. This is kind of an interesting one here. Obviously, we have this huge gap, right? And we spent several months getting up and just barely filling that gap. So something's going to happen there. In this case, obviously, it was a huge move to the upside, back to the prior ceiling at 39. A lot of times, it'll come up and fill the gap and roll back over here. But that's not what happened here. But this point right there, it's a great place to bet, right? Quote unquote bet whether you think it's going to go higher or lower. If you think it's going to roll over, no big deal. If you bought it at 33, thinking it's going to roll over, and it doesn't, you get out of it at 34. If you think it's going to go higher, great, you're in. It's the best risk management points. That's what these are, like risk management points. Okay, so support on the other side. So this is going to be the chart on the right side. Support levels, on the other hand, refers to prices on a chart that tend to act as a floor by preventing price of an asset from being pushed any further down. So you can see from the chart, the ability to identify a level of support can also coincide with a buying opportunity, because this is generally an area where market participants see value and start pushing prices higher. So we had a big move down to 51.25-ish. All kinds of support there at it. Moves higher, comes down. Now you can draw the line across. We made new highs. That's great. Rolled over. ABC down, back to support. Back up, down to support. And if you're watching this play out, you know, just like the iPhone we've been talking about at 75, had that huge level of support at 75. So in the chart in this case, if it was TSP, what will we do? Let's say first you're not in TSP. It comes down. It's hit 1, 2, 3 times. It's hit support at 51.25. It comes down here at 51.25. You buy it, right? If it breaks below that, you just sell it, and you get a little bit of a loss. But you've got a lot of evidence that it's going to go higher from there. Okay. In TSP, we want to confirm it. So if you connect these highs, we've already connected these lows. We got this move higher. We got some consolidation there right above that trend line. I mean, that's a great place to buy it if you're in TSP. And then hopefully you get that gain. It would be great if we could do these. If we could buy based on the support levels. But with the 2 IFT moves a month, it just adds, for me anyway, this is a conservative way to look at it, but for me, I want to see a confirmation of the breakout, which would be right there.
I mean that's not really conservative. That's risk management. You have to do. I think you have to do that.
In our case, you do.
Because you can always get out. I mean, so there's always that. But with the 2 moves,
that's the problem.
And you're doing a lot of guessing at noon.
Oh yeah,
because you don't know. You barely got the market open for a couple hours, and now you got to make a decision. So we talk about that all the time, but that's just the reality of what we're working, of the confines we're working within. So when Jerry points these out, you know, those arrows down there, if we were in an IRA, we would be buy, you know, and selling across that line that he drew at the top. That's support level, right? So there's resistance and support on just about every chart. And another way to look at it, right, we talk about at times is those channels that we draw, right? And so that's your zone there, the support and resistance. And you literally could just buy and sell based on that if you were in your IRA, because you can do those kind of moves. But in the TSP, we have to go with the larger trends. There's just no other way around it. And the folks that don't buy into that are, I think, just sticking their head in the sand.
I mean, it's in this chart, you could kind of do it if you say, okay, I got really good validation of support level there at 51. So the next time, say it's here, you watch price roll over, it made lower highs, it rolled over, and you're like, you know what, I'm going to buy it there at 51 because it's in my TSP. I'm going to buy it at 51 and assume that it's going to move higher from there.
And what buy it in your TSP means, right? And I'm always trying to play the lowest common denominator kind of, I'm just new to this, kind of viewpoint. What we mean by that is maybe you're 100% G fund on that roll down because you see the trend is going down. You're like, I'm out, taking my money out of the market. Now you see it hit that resistance level. You might say, I'm going 100%, or you might even do like we do sometimes and say, I'm going to do 50%, put 50% of my retirement back on the table in the stock funds and get a little of that gain because I'm hedging a little bit. Now, if you're all in, great. You're in 100%. You can go 75%. So when we say buy, that's what we mean is changing your allocations. And we change both of ours at the same time.
Right.
Because we treat new money the same as old money. And over time, the old money is the bigger pot anyway. People always get confused about, I'm buying with this. And yeah, you are, but it's a little bit of money.
Right.
Your pot is the big pot of money.
Right. And actually, the big pot is the only thing that you have control over about when you buy it. Right. So you can't buy at these support levels with new money because you don't have any control of when it's getting purchased. When
it actually happens, because it's coming out of your check, it's got to get processed, and then da-da-da-da. Like, if you think you're going to nail it on the day that it happened, that's just impossible. No. Yeah.
But that's a really good point. But when we talk about buying in terms of TSP, it's doing an IFT. It's doing an interfund
reallocating.
Transfer. Well, reallocating. So change of fund allocation is what it's called in TSP when you want to tell TSP, where you want your new money to go.
Yeah.
Right. And interfund transfer tells TSP
from one fund to the other.
One fund to the next with the money that you already have in the account.
Yeah.
So
I always look at mine as like a pie, and that's my portfolio, right?
Yeah.
And then that pie can take different, allocations, and whatever it takes to make it work in your head. Find that analogy, because as soon as you can wrap your head around it, all this starts to get pretty simple, I think.
Yeah. There was a question, I think, in the public group today or yesterday about that. Like, someone said, "Hey, I'm in the G fund, but I want to, with the new money, I want to put it into the stock funds. Does that make sense?" So yeah, you could dollar cost average your new money into the stock funds when the overall trend is down. When the trend is down, you could protect your main pot of money in the G fund, but then contribute new money into the stock funds, sort of on a dollar cost averaging kind of idea. I just never did that because for me, because like that is a way you can do it, and you can absolutely do that. For me, I was like, if I'm in the G fund in my larger pot of the account, why would I want anything going into the stock funds? Because I know once I see that turn, I'm going to get everything back into the stock fund. So why would I want to buy in with new money? I never really. I understand how people would do that to simplify things a little bit. It didn't work for me, so I didn't do it.
But I would say it doesn't simplify it, meaning now I've got to track multiple things.
Right.
And so if that rings true to you and you understand that process and you can keep those two, pieces of analysis going separately, hey, have at it, do it, right? I mean, we were in jobs where we weren't always in front of a computer and this, most of our career was before cell phones that could, do everything for us. And, we were on a flip phone and you weren't getting stock prices, by the minute. You weren't looking at charts on your Nokia.
Yeah, you're not logging into TSP on your
right. So the world has
phone.
kind of changed. If you had the tools you have available now, maybe, but when we were, you were doing this coming up, that just wasn't possible. So there was no way to kind of work two angles at once. But now you have a lot more data available, and so all I'm really saying is like if what Jerry explained as far as using new money to kind of get in the market and buy, that's dollar cost averaging is a real thing, and it does work. We think it works a lot better outside of the TSP, but it still works. So if that rings true to you, go for it. But I would say the average investor in the TSP, particularly one that's not highly experienced, highly educated, go with the big trends and move all your money at the same time.
Yeah,
and that's what we do, and it's working well.
Yep, I think so. All right, so that's support and resistance, basically, right? Trend lines are the same kind of idea, just instead of it being flat, they either trend up or down. So this is the chart that we're talking about here in the language on this slide, right? So charts show the charts that we just looked at show a constant level that prevents assets price from moving higher or lower, right? It's a horizontal line. It's a static barrier, one of the most popular forms of support resistance, but the price of financial assets generally trend upward or downward. They don't trend on a horizontal line. So it's not uncommon to see these price barriers change over time. This is why the concepts of trending and trend lines are important when learning about support and resistance. When the market's trending to the upside, resistance levels are formed as price action slows and starts to move backward toward the trend line. So when the market is trending up, you're connecting the lows to make that upward ascending trend line. This occurs as a result of profit taking or near-term uncertainty for a particular fund or stock or whatever. The resulting price action undergoes a plateau effect or a slight drop-off in stock price, creating a short-term top. Okay. Many traders pay close attention to the price of a security as it falls toward the broader support and trend line because historically this has been an area that's prevented the price of the asset from moving substantially lower. For example, as you see on the one that we're going to show, trend line can provide support for an asset for several years. In this case, notice how the trend line propped up the price of Newmont's shares for an extended period of time. So we're back here in 2001, and the price goes out to like 2007. So we had some big price moves in here, right? But they always came back to this trend line, right? Yeah, I mean, this is a pretty good example. You see it all the time. There's a one right now that I'm tracking. It looks exactly like this. It's called the CQQQ. It's the Chinese tech index, and it looks exactly like this. On a monthly basis, the Chinese tech index last month was way down here below that monthly trend line, and then it reversed and came all the way back up almost to the trend line right now. But you see this all the time, especially in longer term price charts. But this is the same idea as support and resistance. It's just on a trend and not horizontal. So on the other hand, and that was an ascending, right? When the trend is going up, when the trend is going down, it's on the other hand, when the market's trending to the downside, traders watch for a series of declining peaks. So you're connecting the top of the peaks on a downtrend instead of the bottoms, you're connecting the tops. We'll attempt to connect these peaks together with the trend line. When price approaches the trend line, trader will watch for the asset to encounter selling pressure, right? So when it's hitting that trend line, you're anticipating that the market's going to roll over. May consider either entering a short position, meaning you're betting that the market's going to go lower, because this is an area that has pushed price downward in the past. For our purposes, that's the time where you would consider reallocating out of that stock fund that you're in. Support and resistance of an identified level, whether discovered with a trend line or through some other method, is deemed to be stronger the more times price hits that line historically, right? So the more times it hits that line, the stronger that line becomes. Many technical traders will use their identified support resistance levels to choose strategic entry-exit points because these areas often represent prices that are most influential to the asset's direction. We kind of already talked about that. Most traders are confident at these levels in the underlying value of the asset, so the volume generally increases more than usual, making it much more difficult for traders to continue driving the price higher or lower. So you'll see, there's no volume chart here, but you'll see like this section right there, there was a big up move. It was a big up move right there at whatever, say 42.50, right at the trend line. If there was a volume chart on this price chart, you would have seen a really big, so maybe volume was like this, but you would have had a really big volume day on that breakout from the trend line. It just establishes more support at that trend line. Okay. So that's how you do it for trend lines. And the last one is moving averages. Okay. It's similar, but a little bit different. So most technical traders incorporate a bunch of different techniques, and moving averages is one of them. So to aid in predicting future short-term price movement, traders never fully realize the ability these tools have for identifying levels of support and resistance. As you can see from the chart we're going to show, moving average is a constantly changing line that smooths out past price data while also allowing the trader to identify support and resistance. So take a look at how price of the asset finds support at the moving average lines when the trend is up and how it acts as resistance when the trend is down, right? So rather than connecting the bottoms, okay, this is a 15-period moving average line. I'm not sure if each tick is a day or a week. In this case, it looks like it's a day. So the yellow line is the 15-day moving average. So all you do is, I mean, you don't do it, the computer does it for you, but you average out the price of a rolling 15-day period, and that's that yellow line. So instead of connecting the price bottoms, you just overlay the moving average line on the price chart. And you can see you tend to get support at the moving average line, right? And then on the downside, once it breaks through that moving average line, it tends to act as resistance, right? Price can't get back above it. So traders can use moving averages in a variety of ways, such as to anticipate moves to the upside when price lines cross above a key moving average, or to exit trades when price drops below a key moving average line. We talk about that all the time on the show, and we do it in the charts all the time. Regardless of how the moving average is used, it often creates automatic support and resistance levels. Most traders will experiment with different time periods in their moving averages so they can find one that works best for their specific task. So that's a really good point, because you will not find the tops, right? This isn't to try to get out at the top. This is to try to figure out how low price will get on the pullbacks, okay? And it's the reverse on the resistance side. We don't know how low that decline was going to go, right? What we do know is once it bottoms here, it pulled back to that moving average line, and now it becomes resistance, right? So when because we're going to show it because we're living through it right now, right? Let's say that this was January 6th on the S&P 500, and price was coming down, and we don't know how low it's going to go, right? 2 weeks ago, we had this huge move to the upside, which was basically like that, and everybody was saying, well, how come we couldn't have gotten in back down there? Because there's no. Why would you think it's gonna stop on that day and move higher? There's nothing that indicates it would do that. So you gotta let it play out a little bit, and then what happens when it gets back to this moving average line? In this case, it hit resistance and rolled over, a huge rollover, right? So that's how it's a tool. That's how you use the tools. There are no guarantees. You can see there's a bunch of overshoots, right? The moving average lines aren't an exact science. They're a guide. Okay, so let's look at a real-life application. Here's where we are on the S&P 500 as of, I think it was Wednesday this week. So this dotted line is the trend line, okay? We started at the top in January, and all I did was connect the highs, right? Connect the highs, and it gave us the trend line. So the trend was down, right? It's still down, but we broke through the downtrend line right there. Okay. Is it?
Yeah, it's kind of hard to see that line. It is on my screen, so maybe zoom in and show them that trend line.
The dotted line, you mean?
Yeah.
Yeah. Okay.
Yeah, that's a little easier in case people.
Okay.
So because that trend line wasn't as visible. Anyway,
okay.
so I didn't want people to get that mixed up with the moving average line.
Right.
But so that dotted line there is this is going back, kind of wrapping up all these concepts together.
Yeah,
right.
Right.
And that's what I was thinking. And that's what I like is once you kind of put all these together, what you've got is multiple tools to give you trends, right? You've got trend lines, you've got moving averages, you've got, support and resistance, principles.
Yeah, zones.
Yeah,
right?
and it gives you a bigger picture of all of this.
Yep.
And I know you're getting ready to go through that, so I'm going to let you.
So, I mean, the first one was the trend line. So we broke above the trend line where the arrow is, right? That's the first step. So if we back out, actually, so the gray line is a 10-day moving average line. So we gapped up through the 10-day moving average line right there. Then 2 days later, we got above the trend line. And the day after that, we got above the 50-day moving average line. And then we got above the 200-day. So right now, or as of last Wednesday, price is hanging out right there above all three, right? The 10-day, the 50-day, and the 200-day.
Yeah, and people ask us a lot of times which ones are better, and it's not a better or worse. You use them for different reasons, right? And there's points at which I think it just showed there where they cross.
Yep.
Right, and that gives you more information.
Yep.
And so using all of these as tools to give you that kind of, because what we like to work in is the world of probability, not possibility.
Right.
It's possible that it could go sky high on Monday and keep going forever. Is it probable? We're going to figure out based on the data that we have.
Right.
That's how we approach this.
Right. So last week we were talking about how it would be really bullish if the 10-day crossed up through the 50-day. And so, like I said, this was on Wednesday. I think I did this chart on the 24th. I think that was Wednesday. So the 10-day in gray had not yet crossed up through the 50-day, the red line. But by the close on Friday, it had. So what that means is now you get the 10-day, the 50-day, and the 200-day all kind of converging right in there. And price is above it. So if this holds as support, then price should move higher. if it rolls over and breaks down through all those support levels, right, all those moving average lines, then it's resistance here, and prices it certainly will come down, test the prior lows, and potentially go to new lows. But as long as price is above those moving average lines, the odds are, I won't say the odds, but you need to pick your line in the sand when you want to be in the stock funds and when you want to be in the G fund. And when we're below those moving average lines, you want to be in the G fund. When we're above those lines, you want to be in the stock funds. Okay. We're going to get back again to the charts after this bonus chart, but we're going to get back to the TSP fund charts. But this is something that, again, I go into a lot more detail this weekend on the newsletter, but here's kind of the summary of it. So last week we did, in the show last week, we had 4 bullish experts and 4 bearish experts, right? And we called it the crystal ball show, right? And Larry Williams, one of the guys that was very bullish for 2022. We showed this chart, and in his video, he was referring to the yield curve as not indicating a recession anytime soon, and that's why he was bullish about 2022. So back then, the chart only went, I think, through the beginning of 2020. So this is like the updated chart. So things have changed a little bit, meaning we have ticked down quite a bit, but we're still not below the zero line. So let me circle back here for a second. This is the yield curve, right? The 10-year yield minus the 2-year yield is this line, okay? And the gray is recession. So you can see when we get below that zero line, recession is pending, right? Every time we get down there to that zero line, since back here in 1990 anyway, there's been a significant recession, okay? But it takes a while. It doesn't mean it's going to happen tomorrow. It can take several months. So we're on the decline, right? The 10-year versus the 2-year is declining, but it hasn't hit that zero line yet. So from that perspective, we shouldn't really anticipate a recession imminently, right, within the next couple of months. If we get down here in the summertime, then maybe, we see a recession sometime in the fall or early next year. But we're definitely not there yet. So this is actually a bullish chart because it shows that in terms of the rates anyway, we shouldn't be expecting a recession imminently. And so what exactly is a recession, right? And this is the tricky part. So a recession is a term that refers to a significant decline in the general economic activity of the U.S. is what we're usually talking about. It's typically been recognized as 2 consecutive quarters of economic decline, okay? 2 consecutive quarters of negative GDP, right? The Bureau of Economic Research has officially changed the definition, and now it's not 2 declining quarters of GDP. It redefined it as as a significant decline in economic activities spread across the economy, lasting more than a few months, normally visible in real GDP, employment, blah blah blah. The point is the system has figured out that when you identify a recession as 2 consecutive quarters of negative GDP growth, you've by definition set yourself out 6 months. So a recession began 6 months prior to when it was officially recognized. So if we go back to the chart, these grayed in areas are the time frames that we have had recessions in the past, but they're not officially identified until we're already 6 months into them. So to know in advance when we're actually getting there, you want to know when the yield curve goes negative. When it hits that zero line, that's when you're anticipating the stocks to start rolling over. And then 6 months later, the government's going to come back and say, oh, yeah, we've been in a recession for the last 6 months. So that's, the yield curve is a leading indicator. It's not leading, like I said, tomorrow or the next day, but when it hits that zero line, the economy is not doing well. If the bond market demands a higher rate of return for 2-year bonds than it does for 10-year bonds, it's concerned that there's more risk in the short run than there is in the long run. And again, we go into much more of that in the newsletter. Okay, this is the chart that we were saying was the only chart that matters, right? We've been talking about it here for the last several months. When we got above, so this is a 2-year weekly chart of the C fund. Here's the COVID low. Once we got back above that 20-week exponential moving average line, every time we had a little pullback, we got support, right? Every single time until January, when we had a weekly close below that line again. And then ever since then, the C fund price couldn't get back above that line until this week. So we closed above that line this week. Volume was okay. It wasn't great, but it wasn't horrible. And relative strength is now above that 50 line on a weekly basis. So we were saying that you don't want to be in the stock funds when price is below this blue line. So as of this week, price is back above that blue line. There's no guarantees that it keeps going higher from there, but you need to be in the stock funds when the trend is going up. And a very simple guide is I want to be in the stock funds when the C fund is above that 20-week exponential moving average line, and that happened as of Friday. Okay, so I just wanted to throw this chart in there to kind of supplement it. So we've been talking about that 2-year weekly chart for the last several months. This is a 5-year weekly chart, okay, with the same 20-week exponential moving average line, but it's the closing price, right? It's a weekly closing price instead of the candlestick. So it kind of takes away some of the noise of the intra-week price movement, all right? So it's not 100%, but let's just go through. So from April 2017 all the way through 2017, we were above that exponential moving average line, right? Above the 20-week moving average line. We would have gotten in and out of it a little bit there, right? But we're basically above it. We keep getting support at it until it breaks through here in 2018. Then the line becomes resistance, right? For a good chunk of 2018, we got back above it. We generally found support, right, until the crash in COVID. If you got out when that 20-week exponential moving average line was broken at the beginning of COVID, you saved the majority of this down move, right? And there's no way to know how low this bottom was going to be. Eventually, we got back above that 20-week line, and we stayed there, right? We got support all the way along until January, right? And now we're back above it again. And RSI is back above 50. There is nowhere, at least in the last 5 years, that we get we have a decline through this line and then have a fake breakout. There's nowhere back on this chart where we have a place where we get a little bit above that line and then roll over and come back down below it. It could happen this time, but with the history of the last 5 years, there's no indication that it rolls over. Every indication is it finds support and moves higher.
And as you pointed out, like, is it possible? Absolutely.
Yeah,
it's possible.
Yeah.
Is it probable? Not based on the data and the information that we have that shows it right there in that chart, right? This isn't Conan or Jerry's opinion.
Right.
If you take all of that information in that chart and really all the information you have is the moving average, right?
Yep.
And you got price and you got volume.
Yeah.
Well, we got
And
our
relative
RSI.
strength.
Yeah,
Yeah.
you got RSI in there.
Yep.
So very few indicators is what I'm getting at.
Yep.
Very few things. And if that's the picture you watched as you invested in your retirement in the TSP, you would do extremely well over the course of your career. And that's why Jerry says that's the only chart that matters. You know, sure, there's other charts that matter, but like if there's only one you were going to watch, that could be the one.
Yep.
And if you follow that, you know, that trend, you're going to be very well off at the end of your, you know, retirement when you're investing. And it's not going to matter whether you're early on in your career, middle career, or at the end of your career. You're going to be making the same decision. You're going to be making decisions based on the same data. Right. It doesn't change just because you're somewhere else in your career.
Right.
And but I like this chart because I think it's a very simple representation of what we, you know, try to do in our methodology. And again, pointing out what Jerry said, like, is it possible for it to roll over and go through? Absolutely it is. Yep. We have no crystal ball. We don't know.
Right.
But based on that chart, the probability of that happening is extremely low. And that's what you want to work with. That's how you want to manage your risk.
Yep. And so last part about this, we talked about how this was the last major bottom coming out of COVID. And our plan A, right, in terms of Elliott waves was 1, ABC for 2, 3, ABC for 4, and a 5 that takes us to new highs, right? If that's our plan A, we have this correction for wave 2, we have this correction for wave 4, we got relative strength back above 50, and we got price clearly in rally mode. So is it possible that we roll over? Yes. But for me, it's worth the risk at this point.
And that's not plan A, but, you know, because somebody may call us on this, right? If you were to pull that back a little farther, and if you go back and look at some of our older shows, we'll also say that this rise that we have right now, the angle of that rise is very interesting, to say the least, meaning that when you look at the rest of the last 20 years, it does not climb that steep that fast. Right. And so is that sustainable? Like, we don't know, but it surely doesn't look like it. Right. Which means at some point, right, probability is that it's not right now, but at some point that has to level out back to normal, whatever that is. Sure. And to get there, it might take
come back down.
It might take a big turn down. So at some point we're going to have that kind of leveling out, but the probability of that happening right now seems pretty low. Yeah. Yeah. So that's why plan A is that it kind of takes off again. Right.
So what you just said, if you look at the from April here to the low in COVID, the trend, only I had a ruler to do with this.
You draw better lines than I would.
The trend is basically like that. Right, it's up.
Yeah.
But this
is a whole different animal.
Yeah, that's a whole different ballgame right there.
Yeah. And but we'll be keeping our eye on that.
Yeah. That's gonna be for another show. All right. So that was the C fund. The S fund is not yet back above its 20-week exponential moving average line. I mean, this is the same chart as the C fund, right? It's a 2-year of the S. We're still not above 50 on the RSI, and we're not above the 20-week moving average line for the S fund. So we've had some big gains. We definitely got three weeks of support there at 1800. And if you just drew like this downtrend line, we're above it. Getting up above 2100, because we talked quite a bit about 2100 right here being a pretty important support level back here, and it was violated. Now it's going to become resistance. So the next big goal for the S fund is getting above that 2100 line on a weekly basis. I fund, same kind of idea, pretty much. It was 75. It was huge support for the I fund at 75, and broke through it big time sometime in February. Had some really big down weeks. That obviously was the beginning of the war in Ukraine. The week before last, we had a big move to the upside. And last week, we were talking about, I can't remember if it was the show or the newsletter, but the 74 to 75 level as being a lot of resistance. And that's where we are. We're pausing right there at 73.76. We're the gains from this big up move got digested this week. It's good that it didn't roll over right there, right? So there's support at that level. If it can get back above 75, then we're in this trading range. That would be great. But we're not there yet, and RSI is still below 50. F fund has absolutely collapsed, which again shouldn't be a big surprise because the Fed is telling us that rates are going higher, and when rates go higher, the price of the F fund goes lower. Having said that, at some point the F fund is going to find a bottom, and if you're looking for a bottom in the F fund, RSI is really oversold. It can stay oversold for a long time, just like back here. It can get overbought and stay overbought for a really long time, right? So, price could continue lower, but we had a pretty big gap up right there that got filled this week. So we could be seeing some kind of a low right now in the F fund. But there's a whole lot of negative volume here too. So could be an indication of a low, but we don't know. And I would want to see that low confirmed before I got back into the F fund. And as long as the stock funds are going up, no point in being in the F fund anyway. All right.
Questions.
That wasn't as bad as I thought.
I won't say you're pessimistic sometimes, but you're writing this stuff, right? So you're way into it deeper than we are. We're just observers. So it's hard to take yourself out of that and see how it's going to look. But 99.9% of the time, it's magical.
Well, hopefully it was this time. At least, hopefully it didn't make everybody's eyes roll over. The newsletter is similar. I go into the yield curve a little bit deeper and do some examples, and it's basic, but it's a little bit deeper in why the yield curve matters a lot.
Well, if you have questions, put them in the comment section wherever you find this video, YouTube, Facebook, our website. If you don't have a comment section, you can always email it to us at info@growmytsp.com. If you like the show, please share it with your friends. If you don't like it, share it with your friends. Just tell them how crazy it is. And we hope you guys have a great week. And we are going to be watching the market like hawks.
It's going to be a big week.